Joining us this morning, UBS Private Wealth Management's Alli McCartney is with us. Alli, it's good to see you. Good morning.
Good morning.
So it's another morning here where sort of momentum and tech are lagging. People beginning to argue that there are chinks in the AI trade. Do you agree? And do you think NVIDIA can maybe remedy that when they do print?
You're talking about the right things, which is ultimately the goods market and the consumer. I guess the question still remains the services market and the consumer. I think what happened yesterday is like sort of much of a muchness, right? We are sitting here in a week that is an extraordinarily low volume week, both in Europe and the US. We are ahead of the Fed commentary and coming out today, Jackson Hole commentary, and as you pointed to, NVIDIA earnings. So to me, I really wouldn't take anything that you're seeing in these few days with, I would take it with a grain of salt and assume that what we're really getting is confirmation that the bull market remains intact and widespread agreement when you look at Fed futures market that we're not talking about an if in the direction of rates, we're talking about a when.
So you see no doubt in your mind we're going to get at least one cut this year?
Yeah, so look, markets and UBS are pretty well aligned. We expect there's about an 80 to 90% chance, depending on when you look, of a 25 basis point cut in September. I think the real question is what the rest of 2025 looks like. That's going to be, as a lot of the conversations have been this morning on CNBC, it's going to be both political and data respondent, largely looking at the labor force market. I expect that what we will see is 100 basis points of cuts between now and June of 2025. Again, I think the placement is less of an issue. The Fed funds futures in terms of where we land is in the low threes. And I think that will be the initiation of that. And then the appointment of a new Fed chair will be a tailwind to markets.
But to Carl's point, this rotation out of AI names and big tech, would you tell your clients to buy the dip?
We are definitely, as certainly for the remainder of August, in a wait and see, right? These stocks are up, between 30 and 50% from the low, the trading, the tariff lows. I think that they're very, very richly priced, right? There's reason to argue that they can grow into their multiples given some of the earnings and given the tailwind of rates coming down. But, we are in the 1% of pricing right now. So in a sense, I'm not buying, I'm not selling. And I am very much interested in what's happening in the credit markets. Now, the credit markets is something that hasn't been talked about a lot. Credit markets are interesting and really complacent right now. They're, at a 25-year tight when you look at IG. I think the reason for that is, again, going back to what we were talking about, where the ball's going for the Fed as opposed to an if. And so people are trying to lock in rates. But I think this is a really good example of a time where on both on a lot of parts of your asset allocation, this is a time to wait and see, but not read or parse too much into the data.
Yeah, I mean, Alli, for lack of a better term, August is always a little weird, and it's proving no exception this time. I just always wonder about your clients themselves, given this turnaround. We're seeing it now play out this morning as well with the NASDAQ down, another 1.5%. Do they get worried? Do you get more calls, or is everybody sort of, complacent and or not overly concerned about really what's only a couple of days in the making here in terms of a significant fall?
I'll answer that in two ways. The first way is that this has been, whether it's from a dealing with volatility, emotional or political stress, this has been a really heavy half of a first year. And so I think in general, people are feeling good about their portfolio construction because it navigated well. The high in February to coming back in May. And I think people are really taking a breath. The second thing is that every day my client base, their children, their companies are getting more and more involved in the practicality and usage of AI. So they're actually really starting to see what it is apart from just I use ChatGPT once or twice. And so I think there's this balance of having seen for the first time in many years, which was just a beta market, having seen portfolio construction be meaningful emotionally and from a return perspective to their portfolios, and at the same time starting to experience really what is AI and the fact that it can both from a productivity and from a margin perspective, be a sea change going forward. So there is a lot of comfort right now. I think September, for all the reasons we discussed, in terms of really looking at the health of the consumer, there's a huge bifurcation that we're not talking about between the high-end consumer and the low-end consumer. As I said early on in response to some of Sarah's comments, I think there's also a bifurcation in terms of goods versus services and staples versus discretionary. So I think that really, and the labor market is going to be what we're looking for and what's going to make people and institutions, hedge funds, et cetera, make any changes in, going into the fourth quarter.
Yeah, interesting. September is historically not a great month for stocks. And to your point about the low end, even the Treasury Secretary this week's been making some comments about if you don't own assets, this is not necessarily a great time as a consumer. Alli, we'll see what the coming weeks bring. Good to see you. Alli McCartney.
You too. Enjoy the rest of the summer.